Want to know why stocks rose after a wild day and what surging oil means for your portfolio? Here's how one volatile session reset the market's focus on energy, inflation, and the Fed. U.S. stocks finished higher after an early sell-off as oil jumped on Middle East tensions and headlines shifted sentiment late in the day. Energy shares led the rebound, while rate-sensitive areas lagged as bond yields wavered. The core question now is simple. Will higher energy costs keep inflation sticky and delay rate cuts? Oil's surge matters because it seeps into transportation, shipping, and manufacturing costs. That can pressure consumer prices and complicate the Federal Reserve's path. Recent data already suggests disinflation has slowed compared with late last year. If crude stays elevated, the bar rises for a swift policy pivot. Futures markets are signaling a cautious glide path. Investors want clear proof inflation is trending lower before expecting meaningful easing. The equity tape told a nuanced story. Strength in energy producers and oilfield services reflected improved pricing power and operating leverage when crude climbs. Meanwhile, parts of tech and other duration-sensitive segments moved with yields, underscoring how interest rate expectations still drive growth valuations. Financials and industrials stayed in focus as bellwethers for credit quality and capital spending, two pillars of the broader economic outlook. Earnings season will test margins for companies that are heavy energy users. Airlines, chemicals, and some manufacturers could face input cost pressure if hedges roll off and spot prices stay high. On the flip side, upstream and midstream names may post stronger cash flow and return of capital stories. ETFs tied to energy and value factors have benefited from the recent rotation, while growth funds continue to ebb and flow with each move in yields. Across assets, investors watched Treasuries as a real-time read on policy odds, while safe haven demand, the dollar, and gold reflected shifting risk appetite. Crypto and cyclicals swung with the broader mood, highlighting how quickly positioning can flip when headlines hit. What's the practical takeaway? Track oil and gasoline prices alongside the next inflation prints. Listen closely to Fed guidance on the timing and pace of any cuts. During earnings, focus on margin commentary and cost pass-through. Consider whether your portfolio has the right balance between energy beneficiaries and rate-sensitive growth. And review duration risk if yields stay choppy. Want the full breakdown in charts? Read the full article at finlitica.com.